Hello and welcome to Wealth and Wisdom with the Market Guys. I'm James DeGiorgia.
And I'm Jeff Carbaz.
On today's show, we're going to discuss the current state of the stock market, whether we're in a bear market, and if so, how long will it last? Jeff's going to introduce for us our guest.
Our guest today, James, is Dan Hassey. Dan is a very experienced and knowledgeable trader and investor. Dan has worked for Merrill Lynch in the Beverly Hills office, as well as Payne Weber and Fidelity. He works now for Right Side Investors 21st Century Alert in the research department. Thanks for being on the show today, Dan.
Thank you very much for asking me. Glad to be here.
So I guess the first question has to be, what's the definition of a bear market?
The basic definition is that a market is down 20% from a previous high, from a peak. And so that's a basic definition. Over the years, that definition has expanded, and so I think you can also include that the backdrop of a bear market is a negative economy with negative earnings, and also a backdrop of a negative psychology. And those are certainly things that we have in the markets now. A lot of the markets, actually the Dow and the S&P are not down 20%, but a lot of the other indicators and indexes are, or industry indexes are. You certainly, today you look at the Wall Street Journal and half the articles are very negative, so that presents a psychology. And if you look at certain industries, especially banking or financials, the earnings are really, really bad. So is housing and a lot of consumer stocks. But there's certain sectors that are okay. So you know, our economy is certainly more diverse when these indexes started. So again, the definition is a 20% decline with a backdrop of negative economic reports, as well as a negative psychology.
Dan, in 2000 we had the bursting of the tech bubble, and this has clearly been first the bursting of the housing market, which then translated into the mortgage market, which then translated into the banks, which now has translated into the consumer. Does the domino effect stop with the consumer, or does it continue on and we actually have our first really severe recession since the early 70s?
You know, that is the ultimate question. Will these really, if you look at the consumer is really, really an important part of our economy. It's close to 70% of our economy. So if the consumer goes, we're probably going to go too. And the consumer certainly is pulling back because of the housing, because of high prices, and now also high energy prices, and also because of the just concerns about jobs and income and things like that. So the consumer, and also lots and lots of debt. If you look at past recessions, the consumer really increased their savings, and that helped them through the recessions. In the last recession or bear market, because interest rates went so low, they did not save. They actually went out and borrowed because it made sense to borrow. So you don't have the balance sheets. You know, I think part of the problem this cycle is just too much leverage from consumers, certainly the banks, investment companies, and investors. The corporate side, it looks pretty healthy. So every cycle is slightly different, and what makes this different is that the other thing to add to what you were asking is what's very different about this cycle is that you have a global economy that seems to be healthier. We've never gone through a market cycle where the rest of the world seems to be okay. Normally, if we had a bad economy, that the rest of the world will follow us. But it seems like China, India, Russia, parts of Latin America, especially Brazil, seem to be pretty healthy. Europe seems to be healthy, and so they might be able to minimize the problems that we have.
Well, the one big question is, you know, we hit on the $64,000 question, so I'd have to say that the $32,000 question is, we are the world's biggest customer for everyone, for China, for India, and if we get sick, does that mean everyone else, at a minimum, catches a cold?
Well, you know, if you talk to most economists, they think we could be okay, and there's this thing called decoupling, and that's what's really interesting. If you look at like General Electric and Federal Express, they're all reporting, listen, the domestic business is really difficult, but overseas we're doing fine. So there seems to be a disconnect between these countries doing okay, but if you look at their markets, they have crashed also. So the markets are telling us, yes, everything will pull back, but we don't see it yet. And also, you know, an important part of all this equation is earnings. And earnings seem to be okay too, except for those areas that I mentioned. Actually, I was looking at the Dow earnings for over the weekend, and they're doing 2009 forecasts, and it's over 1,000. So if you give that a 15 multiple, that's a PE of 15,000 if these analysts are correct. And analysts have never been able to, if you look at all the analysts and economists, if you look at the history, can they call it a turn in the market at these crucial points? No, they have a horrible track record. So they may be too optimistic, and the question is, will they have to revise those earnings estimates downwards? But right now, they're still optimistic. 1,000, again, the Dow should earn about $1,000 in earnings. You give that a really a normal multiple or even a moderate multiple of 15, that's a 15,000 down, and the Dow's, 12,500, something like that.
Now, a huge caveat to all this is obviously the dollar. And when we look at the Dow Jones Industrial Average, it's made up of the 30 biggest companies who are mostly doing business overseas. And they get the benefit of a weak dollar. If at some point, the second half of 2008 into 2009, we get a reversal of the dollar, then that could be a different situation in terms of that earnings number being hit, potentially, correct?
That's very true, very true. But still, let's say you get a nick of 5 or 10%, that means the earnings will be about 950. That's still a 14,500 Dow, substantially higher than where we are now. The question, and that's a very good point. If the dollar does reverse, we will lose some of that benefit that we get from the multinationals in this story of decoupling.
So as an individual investor then, wouldn't the individual investor want to really be paying attention to what's going on with the dollar right now? Do you think that's one of the more important issues for them to be watching closely?
Yeah, for several reasons, and here's another important point. If you look at the flow of money from investors, it's really going into international stocks. So if you're investing internationally, if you look at where money's flowing, people are understanding that they need to invest internationally. And if the dollar does reverse, that's going to hurt their investments, because when that conversion is made and the dollar is higher and you're in a different currency, you're going to lose right there, because you're not going to be able to buy whatever currency you're in as many dollars if it's stronger. And so you're going to lose right there. So international investors can get hurt, and they do have to pay attention to the dollar for those reasons that you talk about. And one of the ways they can minimize that is look at the fund that they do. And some of them can hedge with currencies, but also what might be better is some of them are global mutual funds are investing where they can invest in the United States or diversify even more. So if they're investing in mutual funds globally, they may want to, there's mutual funds or ETFs called global, which means inclusive of the United States, and the international, which will not include. So they might want to look at some of the global funds versus the international funds to help them with that.
We may be in a different situation, though. I mean, granted, the dollar may reverse, but it could also continue to decline, which would mean that the projections of $1,000 of earnings on the Dow 30 was actually low.
That's true.